Hi, everyone. Welcome to our Icon on Broadway multifamily opportunity. We're not buying because we're optimistic. We're buying because we believe today's market is creating one of the best buying environments in more than a decade. I'm Gary Lipsky, founder and president of Break of Day Capital. And over the next 30 minutes or so, I'll tell you how we're different, why we think this is a great opportunity, and why we think this is the best opportunity to invest since the great financial crisis. I'd be happy to answer any questions you have at the end. Just put it in the chat. So we have a disclaimer, protects you, protects us. You feel free to read it later. You could get the deck on our portal, and we'll be sending this out as well. More disclaimer. So about Break of Day Capital, we've raised over $110 million to date, 10 million of which came from the Break of Day Capital team. So we're fully aligned. We've also distributed over $40 million to our investors, selectively acquired 2,100 plus units in Arizona with a total value of about $350 million. And we have a strong focus on asset management. Over our first 10 value add deals, we've increased the NOI 40% in the first year. I also wrote two best-selling books, Best in Class and Invest Smart. You can get that on our website. We have a great team. It takes a team to, we currently manage 10 properties, 1,700 units in Arizona. Tim is our director of asset management. He has over 10 plus years in senior institutional real estate roles, has managed over $4 billion of real estate. Joe is our director of investor relations. He's been actively investing in real estate since 2003. He's invested passively in 50 plus deals. And he actually started as an investor of ours before he came on board. We also have Jacqueline, who is our operations manager. She does all the behind the scenes things that makes our job easier. The portal, social media, investor reports, stuff like that. She helps put that together. Andy Wong, our investor relations manager, he has over 20 plus years overseeing institutional and private investment portfolios. He also started as an investor before coming on board. And Tiana Graff is our analyst. So why Break of Day Capital? We go a mile deep versus a mile wide. We don't look at multiple asset classes. We don't look at tons of different cities. We focus on only a few cities so we can be experts in those cities. We also have massive economies of scale. So we have 1,600 units right now in Tucson, Arizona. And when we get an appraisal looks at our properties, they frequently don't like our expenses when they look at it after multiple years because they think, how do you get it so low? Because they're not dealing with companies that have so much depth in that city. They're used to appraising properties with people with a much smaller scale, and we've outperformed our competitors on a consistent basis. We have low fees. We don't charge a disposition fee, a refinance fee, signing on the loan. We just have two basic fees: asset management and acquisition fee. We also have, we do a European waterfall. And what that means is investors get paid back first, 100% before we go to a waterfall. So very, very investor friendly. We have a tried and true business plan. Value add is something we've done time and time again. We look for every property is different. So we look for ways that we can add to the income lines and ways that we can save on the expense lines. And also quality over quantity. We've only done 4 deals in the last 3.5 years. This is our first deal in a year. If there's great deals, great opportunities, we'll do more. If they're not, we're not going to chase a deal just to do a deal. So here's our portfolio. The 4 that went full cycle are on the bottom, and we outperformed those expectations. And this is Icon on Broadway. Uh, this is what we recently purchased. It's a beautiful property. So why Icon on Broadway? Well, these are the reasons why we like it. It's an off-market deal that we bought, located Class B workforce housing community with strong in-place demand. Off-market acquisition at about 50% below replacement cost, which is a great buy, and appraised at 34.5 million, $1.7 million above acquisition price. Projected Class B returns, and that means if you invest under 500,000, 16% IRR and a 2x multiple. If you invest 500,000 or more, it's 18% IRR projected and 2.2 equity multiple. We project over 90% bonus appreciation in year one. So if you invest $100,000, we project over 90%, $90,000 loss on your K1. And we get the K1s done in time. I know a lot of deals don't do that. We make sure we get on it right away. There'll also be more depreciation in years going forward. And we have conservative underwriting that doesn't rely on aggressive rent growth. We have 0% in year one, 1% in year two. I know everyone says conservative underwriting, but we really feel that we do that. And we project about 6% cash flow in year one. This is our business plan. The property was originally called River Oaks, and we're rebranding the property to Icon on Broadway to better align with our other properties and our renter profile. We have targeted amenity upgrades, so adding a secure package locker, and what that does is makes it more convenient for our residents, where they could pick up their packages 24/7, 365 days. And also, it saves time for our staff for not having to deal with that. We're going to add a pergola and a barbecue area to improve daily usability and retention, and foster that community feeling that we like to do at all of our properties. We'll also do a physical refresh, so updating the paint, adding more curb appeal, doing some landscaping, resurfacing the parking lot. Again, these are low cost things that we can do to keep retention high and lower turnover costs. And there's also some deferred maintenance that we'll have to address as well. So current status, the property is 90% occupied. We've already started our landscaping project. It's about 50%, probably a little bit more completed. Originally in our budget, we had a very expensive pipe replacement project, but we did find an alternative. We did a lot of research, and this company is used by the Navy and a lot of other operators, and we spoke to these other operators, and they had nothing but great things to say about this. We've already started that project. I think that they'll be done any day now. They were there all last week. What they do is add a corrosion inhibitor to the pipes and cathodic protection. So very, very cost effective and very, very effective. New signage. We have new signage out in front, and we just have to finish up all the rest of the signage throughout the property. And I'm excited to say July 1st is our first distribution for our Class A investors, and for Class B and C, that starts August 3rd. So our Class A goes out monthly, and our Class B and C distributions go out on a quarterly basis. If you don't know the Tucson market, it's has a very diversified job market, and that's one of the reasons we like it. If if uh, if a business goes out of business or moves, we're very well protected. And as you can see, diverse landscape here. What we also love about the property is its location. It's on a very busy street across from Home Depot, Kohl's, PetSmart, Sprouts, Ashley Furniture. There's some medical office buildings next door to us as well. So that saves a lot of money on recruiting costs. And we also have three properties pretty close by as well. So why now? We're seeing the highest cap rates in about 13 years. And we've had a 3-year pullback. And historically, that has led to 11-year run-ups. So it's a great time to take advantage of this. The fundamentals are very, very strong, and it's a quality asset with massive tailwinds, and that creates asymmetric returns. It's a 1982 build, 300 units, just under $33 million and just under 110 a door, which is a great, great price. Loan to cost 64.5% and loan to value 75%. It's a 5-year fix at 6% and 5 years IO. So very secure, very reasonable rate. It's got a nice unit mix. The studio's 1+1, 2+1, 2+2. Very affordable rents as well. Sales comparables. So obviously you can see our price per unit that we're paying is far below our competition that has been bought recently. Not a ton has been sold in the last year or so. And look at that price per square foot, significantly less than the competition. This is our pro forma. Um, we have nice, reasonable growth over the next few years. Again, 0% rent growth year one, 1% year two, I think 1.5% year three. And you can look in detail in the investment summary, and we'll send this out to everyone as well. This is our CapEx budget, and again, like I said, we hope to save a significant amount of money on the plumbing lines, but we have a lot of extra reserve because things break, and even if you have a good um, report after due diligence, you still want to have that money. The lender actually only required $375,000 for CapEx. Here we are budgeting 2.9, but we'll probably go down a little bit after we see the results from the cathodic piping plan that we've installed. So key risks and how we underwrite for them, because with any investment there are risks. So it's really important for us to think about that from the beginning. And this is how we address it. So when we look at market and rent risk, we're looking at potentially slower rent growth or short-term pricing pressure. We face that with some of the properties that we bought in 2022. And so we address that by having conservative underwriting, which assumes 0% rent growth in year one, 1% in year two. And that's far below the projections from Yardi, CoStar, RealPage, Apartments IQ. Then we look at expense risk. And what I like about Arizona, we don't have high real estate taxes. It doesn't get reassessed every year. There's a maximum it could go up is 5% on a yearly basis, as well as insurance costs. It doesn't have natural disasters in Arizona, so our insurance costs are significantly lower than many other states. But our pro forma reflects current elevated costs, not historical lows, with conservative year-over-year increases. When it comes to interest rate and exit risk, higher for longer rate environment may impact exit pricing. Certainly, that's been the case the last few years. And we're not underwriting for interest rates to go down. I certainly hope they go down, and I hope cap rates go down, but that's not how this is underwritten for. If we get that, fantastic. Now this becomes a grand slam, but that we underwrote it for a double. An operational risk. One, we manage many properties in the Tucson area, and we've been doing that for a very long time. So we get much lower costs with our vendors. We have thousands of data points, deep local market insight that gives us a huge competitive advantage. Here's our sensitivity analysis. So this is for Class B. If you invest under 500,000 based on a 6% exit cap and 90% economic occupancy, we get that 16% IRR and a 2x return. And you'll see if economic occupancy goes up and cap rates go down, we go to the high right corner. And if cap rates expand further and our economic occupancy goes down, then our projected returns go lower. So it just helps you see the variability that can happen on a deal. But this is what we project right now. So we have three different investment classes. We have Class A, and those are people looking for more of a higher cash return right now. Maybe they're on a fixed income. Um, so that provides 10% on an annual basis paid out monthly. And they don't get appreciation and they don't get depreciation, but they are above in the capital stack as far as getting that 10%. And we have Class B, and that's for people that typically invest under 500,000, 7% pref, 70-30 split to 15% IRR, and then 50-50 thereafter. And Class B, if you invest 500,000 or more, it's an 8 pref, and again, 100% of your money back first, and then an 80-20 split. This is our projection on the cash flow. So 6% in year one. So if you invested 100,000, $6,000 year one, 6,500 year two, 8,000 year three, and continues to go up from there. And then year five, we project the sale year and the proceeds from the sale. So if you invested 100,000, you'll get 200,000. That's what we project over the 5-year old. We look to double your money within 5 years. For Class C, if you invest 500,000 or more, you get a nice bump for putting in some more money. And on this slide shows the tax efficiency with the bonus depreciation. And not everyone can take advantage of that bonus depreciation year one. This has to be used, that loss has to be used against passive income. And if you don't have any passive gains, then you hold it to when we sell the property. But you can see how much it rocket fuels your net worth. It's certainly done that for me. You don't have those the tax efficiency with a lot of other investments, and that's what I love about real estate. So investment highlights. Like I said before, well-located Class B workforce housing community with strong in-place demand. It's a great place to be. C class is a little rougher. A class is very nice, and that's what they build. They build Class A because that's what pencils. You can't build new Class B typically, and so we really stand out in the marketplace. It's an off-market acquisition at a basis 50% or more below replacement value, so it really protects investors' capital. We have some nice conservative projected returns and cash flow from starting year one. We are, like I said, we're having a distribution tomorrow, and then for Class A, and then in a month for Class B and C investors. Just so you know, like I said, I've invested millions of my own dollars alongside our investors. I personally guaranteed all of our loans, loaned over $2 million at 0% interest to support our properties. And I only win when our investors win. There are very few who have spent years becoming experts in one market, and that's what we've really done. So here's our information. If you have questions, you could book a call with me, email me. You can go to our investor portal, but happy to answer any questions. Just put them in the Q&A. And one more note, we're buying when others are afraid. This isn't 2021. Cap rates are higher, financing is harder, competition is lower, and that's exactly why we're excited. We've already raised over $9 million because investors recognize that opportunities like this don't come along very often. We're not asking you to invest because we have a great property, which we do. We're asking you to invest because we believe the next 5 years will reward disciplined operators who bought great assets during one of the most challenging periods our industry has seen. If that philosophy resonates with you, then we'd love to have you join us. All right, we got a question here. What makes this property different from others you've looked at recently? Excellent question. We've seen a lot of junk, quite honestly, over the last 6 months, 12 months. Older properties that need a lot more work, that are not on a busy street like this. This is institutional grade. It's a very, very compelling story. And so when the broker called me, and said, "Hey, we've got this deal. Would you be interested in it?" And he ran the numbers and the location and everything. I knew the location, and I said I'd be very interested. So Tim and I, when we go out and visit our properties, we visited this one. We liked it. We worked on the underwriting and started working with our insurance broker to get a quote, our loan broker, and we just kept fine tuning our underwriting, fine tuning our underwriting. Ultimately, we landed on a price that worked for us and with the seller, and that's why we thought this deal was different and it made sense for us. All right. How does owning multiple properties nearby benefit this investment? It does tremendously because we have data points. We have a property right down the street, Icon on Spanish Trail, and that's not on Broadway. It's on a side street, and it's a great property. It's performing well, but boy, being on a busy street like this really allows us um, to get many more people driving by and seeing our property and coming by. So it lowers our costs. We have thousands of data points because we have two other properties besides Icon and Spanish Trail, not too far from there. And this is our ninth property in Tucson right now. And like I said, we've sold three other properties. So it really gives us beautiful economies of scale. We can move staff when we need to. If someone's out sick, we can cover. It just gives us so much operational flexibility. What other questions do you have? And if you have questions that you think of later, again, feel free to reach out, email me, book a call, whatever. We're happy to answer those questions. And even after you invest, if you have a question, like we're always accessible. Not it's once you invest, it isn't like we're not reachable. We respond very, very quickly. We pick up the phone when you call, good times and bad. I wish it was all rainbows and unicorns, but it's not. But we're always accessible. We have another question. How is the property performing since closing? Like I said, 90% occupied, so stabilized, doing very, very well. We're excited about the business plan that we're implementing. We closed recently. I've already been by it probably 2 to 3 times already, and we consistently are there at the property. Weekly. We have our weekly calls with our property management team. We're always uh, available to go through all the data points, our KPIs that we get on a weekly basis, and our monthly financials to really understand what's going on and make tweaks on a very quick basis to help the property perform better. Cecilia, I see your hand raised, but feel free to put your question in the chat. see. What other questions do you have? Well, like I said, if you come up with any other questions, don't hesitate to reach out. Happy to answer them for you. Like I said, we've had a great response so far. We've raised over $9 million for this opportunity. We'd love for you to come along the ride with us. And I hope to speak to you soon. Thanks so much for taking your time. I know everyone's time is super valuable. And I hope you learned a lot about us, how we look at deals, and why this opportunity we feel is a great opportunity to buy, particularly in this market today. So thank you.